You'll find 1,000 strategies online for making money in the stock market. Most sound smart, they feel complex, and you might even believe you're learning something powerful. But here's the truth. A lot of those techniques don't actually work in real life. Now, there are just a few methods out there that are simple, easy to understand. And if you stick with them, they can actually make you wealthy. They don't require a fancy finance degree or an MBA from Harvard. All you really need is knowledge and patience. Today, we're breaking down one of those methods, the exact investment strategy used by Warren Buffett. Yes, that Warren Buffett, the man who built an $18 million fortune starting from scratch. No trust fund, no lucky break, just smart moves and long-term thinking. So let's get into it. Buffett's strategy is called value investing, a style he first learned back in the 1950s. That's when he picked up a little book called The Intelligent Investor by Benjamin Graham. The core idea? Find stocks that are undervalued, companies that are trading way below what they're truly worth. Buy them cheap, wait patiently, then sell for a profit. Early on, Buffett followed this strategy to the letter. He'd dig through old financial statements, hunt for beaten-down companies with low stock prices, hold them for a while and flip them for a gain. This approach was known as the cigar butt strategy. Imagine picking up a half-used cigar off the ground, getting one more puff out of it and tossing it. That's how these investments worked. You'd make some quick cash, sure, but you weren't building lasting wealth. Buffett later admitted this kind of investing didn't build long-term success. It worked in the short term, but it wasn't sustainable. And that's where the evolution began. So what changed? Well, Warren Buffett met a man who completely shifted his thinking. Charlie Munger, his lifelong business partner. Charlie told him something simple but powerful. It's better to buy a great company at a fair price than a fair company at a great price. That one sentence changed Buffett's entire investment philosophy. He stopped looking for just cheap stocks and started looking for businesses with real staying power, companies that could grow and compound over time, companies with strong leadership, predictable earnings, and what he calls an economic moat. Now, you've probably heard that term tossed around before. Moat. But here's what it means in Buffett's world. A moat is a competitive advantage that protects a company from its rivals. Think of it like this. Coca-Cola, that brand is its moat. Nobody drinks a generic soda at a party and says, "Wow, that's better than Coke." Apple, its moat is customer loyalty, design, and its ecosystem. These are businesses that aren't just profitable. They're sticky. They have something unique that keeps customers coming back year after year. And Buffett realized, if you can buy into these businesses at the right time and hold them long enough, you don't just make money, you build generational wealth. If you're finding this helpful so far, take a second to subscribe to the channel. We break down timeless investment strategies, like this one every week in simple, no BS language. Also, drop a like if you want more Warren Buffett-style wisdom explained clearly. All right, back to it. Once Buffett made this shift in mindset, everything changed. He started buying businesses like See's Candies, not because they were dirt cheap, but because they had pricing power, customer loyalty, and a product people loved. He wasn't just investing anymore. He was becoming a part owner of businesses he truly understood and believed in. And here's what separates him from most investors. Buffett only invests in what he understands. If he can't explain how the company makes money, or where it'll be in 10 years, he doesn't touch it. No hype, no gambling, just pure logic. All right, let's talk about Buffett's 3 golden rules of investing, the mental checklist he never compromises on. Rule 1. Only invest in what you understand. Buffett calls this his circle of competence. If you don't understand how a business makes money, how it grows, or what could threaten it, don't invest in it. This rule kept him away from all the hype stocks, crypto and tech companies he didn't fully grasp. It's not that those investments were bad. It's that Buffett never bets on something he can't explain in plain English. Rule 2. Look for a company with a durable competitive advantage. That's the moat we talked about earlier. He wants businesses that can raise prices without losing customers, that have loyal buyers, strong branding, or a supply chain no one else can copy. Whether it's Apple, Coca-Cola, or American Express. The companies Buffett loves are built to last. Rule 3, always buy with a margin of safety. This one's big. Even if a company is amazing, Buffett never pays too much. He always wants a discount, just in case things go south. Think of it like buying a $100 bill for $70. That's what he means by margin of safety. It protects you from unexpected losses, like a recession or a bad quarter. Now here's the crazy part. Buffett doesn't make dozens of trades every week like some Wall Street guy in a movie. Nope. He might wait months, even years, for the right investment to come along. The stock market is a device for transferring money from the impatient to the patient. That's one of his most famous quotes. And it's true. Most people panic when the market drops. Buffett buys more. Most people get greedy when prices soar. Buffett steps back. He plays the long game. And that's exactly why he wins. So let's get practical. What kinds of companies did Warren Buffett actually invest in? We're not talking about flashy startups or some futuristic tech gamble. Buffett made billions by investing in what most people would call boring businesses. Take See's Candies, for example. He bought it in the 1970s for $25 million. That's it, a candy company. But See's had something special: loyal customers, pricing power, and a product people love to gift. Today, that single investment has brought in over $2 billion in profit, and Buffett never sold it. Then there's Coca-Cola, one of his most iconic investments. Buffett didn't buy Coke because it was trendy. He bought it because it was everywhere, easy to understand, and had an unmatched global brand. He purchased around $1 billion worth in the late 1980s and just held on. Fast forward to today, that investment alone earns Berkshire Hathaway over $700 million a year in dividends. And what about Apple? Even though Buffett stayed away from tech for most of his life, he finally bought into Apple, not as a tech company, but as a consumer brand with insane customer loyalty. And it worked. His Apple shares are now worth more than $100 billion, and it's one of the most profitable investments he's ever made. You know what all these companies have in common? They make things people actually use. They have pricing power. They're run by strong, disciplined leaders, and Buffett bought them at the right price, and then held them for decades. That's it. No crazy trades, no guesswork, no jumping in and out. Just smart, long-term ownership. Let's talk about mindset, especially during a market crash. Most investors panic when the market tanks. They sell low, regret it later, and swear they'll never invest again. But Warren Buffett? He does the exact opposite. In 2008, during the global financial meltdown, while the world was freaking out, Buffett was buying. He invested billions into companies like Goldman Sachs and Bank of America, when no one else would touch them. Why? Because he understands one key truth. Be fearful when others are greedy, and greedy when others are fearful. Buffett treats market crashes like Black Friday sales. When prices drop and everyone else is scared, he sees opportunity. Because if you've done your research and you know the value of the business, a lower price just means a better deal. He says the stock market is like a voting machine in the short term, but in the long term, it's a weighing machine. It always reveals the true value of a business over time. So while others are chasing trends or checking prices every hour, Buffett is playing the long game. And that mindset has made all the difference. Here's what most people forget. Warren Buffett didn't become a billionaire overnight. In fact, he made 95% of his wealth after the age of 60. How? Compound interest. That's the magic formula behind everything he's built. He started investing at age 11, and then he just never stopped. He let time do the heavy lifting. Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." Buffett understood it better than anyone. And instead of chasing hot trends or get-rich-quick schemes, He stayed the course. That's the real secret. Invest early. Invest consistently. Hold for the long haul. Reinvest your earnings, and don't mess with the process. The average investor tries to be smart. Buffett just tries to be rational. So what can you actually take away from all this? You don't need to be Warren Buffett. You don't need billions to start investing. But if you follow his principles, you can build serious wealth over time. Here's your action plan. Understand what you're investing in. Look for strong companies with long-term potential. Buy when they're undervalued, not just when they're popular. Stay patient. Don't panic. Let compounding do its job. Buffett once said, "The stock market is designed to transfer money from the active to the patient." So the next time you feel the urge to day trade, time the market, or follow hype, remember, wealth doesn't come from motion. It comes from discipline. Warren Buffett's strategy isn't flashy. It's not exciting, but it works. And it's worked for over 70 years. He's proof that you don't need to be fast. You just need to be right. And you need to stay in the game. So if you want to start investing like Buffett, don't overcomplicate it. Focus on learning, stay patient, and build habits that last. Because in the end, time rewards the patient, not the busy. If you enjoyed this breakdown and want more timeless investing wisdom, explained simply, hit that subscribe button, give the video a thumbs up, and let us know in the comments which part resonated the most with you. Thanks for watching. And remember, wealth is built quietly, patiently, and with purpose.